I got it. Happy Friday. Looks like I'm live right now. Am I live, Mars? Yeah, I think I'm live. All right. So wearing my SubTo apparel or owners club. Like Pace Morby. He's always got the sweatshirt. So represent owners club. So hi, my name is Adam Levine, founder of Levine Capital, member of SubTo Gator, and now owners club. I am an expert in creative finance. We specialize in a lot of institutional fix and flip loans, DSCR loans, ground up construction, a lot of 1 to 4, mostly our bread and butter. We can go 5 to 9 units, and we will be expanding our product offerings to other types of asset classes. And another thing I did not mention, we do a lot of earth deposit loans, transactional loans, double closings, and some other funky stuff we've done in the past. That's more private capital. The double closing and the transactional loan or EMD could be institutional as well. We do have backing for that. Now, in terms of the Morby Method, this is a very, very exciting topic. Let's let more people join, and I will get to it more. So let me share my screen. Actually, I think that'd be a good idea. Share my screen. Okay. Let me see how I do that. Um, Share screen. All right. I'll do this one. Not share like multiple screens as well. So again, my name is Ad Levine. I'm the founder of Levine Capital. I am an expert in creative finance, member of Owners Club, SubTo, and Gator. And we focus on a lot of, you can see right here, a lot of fix and flip, fix to rent, same type of loan. It's just when you hear about the fix and flip, fix to rent, do not get confused. What that means is really, if it's a fix and flip, you're going to buy, renovate, and sell. Fix to rent, you're going to buy, renovate, and refinance. Stabilized bridge, basically, that's a short-term loan on properties that are rent ready. There's multiple reasons why you would go for a stabilized bridge over just a fix and flip. DSCR rental, those are 30-year loans. You could have shorter terms, ARMs. Generally, the cheaper rate is a 30-year term, 30-year fixed, and there's more nuances like prepayment penalties or whatnot, but that's not for this discussion. Ground up construction and the Gator. The Gator lending, the prices of the earnest money deposit loan, the transactional loan, the double closing, any type of, let's say, out of the box type of lending, I would say could fit in the Gator and could be factoring. And if we can't do it, that type of loan, we do have a lot of resources. Being part of Owners Club, there's so many resources, and that's another reason why you would want to work with a company like us or any other companies. It's not just the lending. Yes, you can get really awesome rates and leverage or whatnot, but what other value do they offer you? Are they just going to offer you rates and leverage, or they offer you resources? We're here to strategically guide you to the appropriate loan type or not. A lot of people come to us, oh yeah, I have a loan and a DSCR loan, and meanwhile there's a construction budget. So it has happened. I have phone calls all the time where there's actually a renovation component to that project that they're taking on, and meanwhile the broker is bringing it to a lender as a DSCR loan. However, that's not the appropriate loan, and then it could fall apart. So I like to really strategize, figure out what is your business plan, and guide you appropriately. Lots of resources that we offer. We have gap funders, we have connectors, we have transaction coordinators, transactional lenders. We have, you name it. Someone called me. They're working on a boutique hotel in Puerto Rico. A good friend of mine. He's actually, we spoke a few weeks ago. He told me he left his 9 to 5. He's a Wall Street guy, bond trader. Left his 9 to 5. Now he's focused on full time entrepreneur basically, and he's actually doing deals in Puerto Rico. So I mentioned to her, send me over your project, more details. I don't mind making an introduction to my friend who's actually he's investing in boutique hotels in Puerto Rico. So that's something different we do. We also have off-market properties from wholesalers, could be realtors, from any source that we could pass those opportunities to you. We have it's just so much stuff that we're working on. And now I believe we have Morris, how many people we have on here now? No, I'm talking, but I also want to get right to the bottom of it, what we're working on. All right. So this is the Morby Method. Now, the Morby Method, I learned about the Morby Method from Pace Morby. I think it was a few years ago. I heard the concept. I understood right away all the moving parts of. I got the understanding of it right away. It can be rather confusing because does a DSCR lender allow it? There's so many moving parts. But we're gonna have multiple lives on this, but I just want to go over a high level of how this works, and then I'll give you some examples. Okay, so this is basically a strategy where you could buy properties with little to no money out of pocket. Okay, and you could possibly even get paid at the closing table. And it sounds crazy, but you could get paid and have no money out of pocket. Usually, this is a strategy where it could be for a fix and flip loan or short term. Depends if there's renovation needed or possibly ground up. I have not done those yet. All of our mortgages, for that matter, were turnkey rentals where seller is offering seller financing. Okay, so for this presentation, we're talking about DSCR with seller financing. And basically right here, what if I told you there's a way to buy rental properties without draining your savings, even if the seller wants a big down payment? And so this is actually a cool example. So a broker of ours, one of our VIP brokers, came to me, it was last summer, I forgot the month. The seller runs a turnkey operation in Cleveland, Ohio. He basically buys, renovates properties, and then manages them. He sells them off to turnkey investors. He offers seller financing. He offers 15% carry, meaning he's willing to carry 50% of the giving you as your a loan to you, basically. Caveat is you got to come up with 85% of the down payment. That's a large chunk of money, right? So then it dawned on me. I was like, wait a second. I think I could pull this off with a Morby method. And I'm thinking to myself, like, this may be a long shot, but because there's so many things. This came as a portfolio loan of scattered single family houses. They're a blend of I forget the unit count or the unit type. Of could have been two families, single, or is a portfolio. And so I thought there's so many things that could happen, and we closed it. We had proof of concept that we closed many more. Everybody was happy. Seller was happy. Broker was happy. The buyer was happy. And that was really it was actually one of the most exciting opportunities I ever worked on, because it was a lot of there was a lot of brain damage, put it that way, because we had to figure out multiple issues came to fruition, then we had to figure out how to solve these issues. So at the end of the day, we were able to structure from a 85% down payment from the buyer to only 5% down plus closing costs. That is pretty cool. And okay, so obviously we'll leave questions to the end. And do me a favor, if you have any other questions, please email us or just leave a comment and we'll address it next time. Okay, so give me a second. So right here, this is actually a quick presentation that was created from my autonomous AI agent, Manus. Manus is amazing. I love it. In fact, I highly recommend it. If you want a link, I believe it's still sign up only. I can give you a link. You can sign up. Amazing. They actually created this like that. So there's multiple things. Here's a very simple breakdown from Manus. The Morby Method is a creative real estate financing strategy that combines DSCR loan debt service coverage ratio plus second financing plus seller financing. So what's going to happen is at a high level view, right? So let me go back to the Cleveland, Ohio example. So there's a few moving parts that you need. You need the right DSCR lender, okay, that knows how to structure the second lien behind the DSCR loan properly so it doesn't trigger any problems. You need the right transaction coordinator. You need the right title company. And so you need all the right counterparties to basically make sure this could move so you could close. Because there's so many things that could blow up the deal. Not having the right transaction coordinator. Unfortunately, in my opinion, you want to have someone with experience. We only work with ones that actually have experience, because I just got off the phone with someone recently, and basically the attorney on the seller side with an inexperienced TC that didn't know how to handle the attorney's objections basically blew up the whole deal. So you had a deal killer attorney and a TC that was inexperienced. That is a recipe for disaster. What could have mitigated this deal from dying is an experienced TC that knows how to handle all the objections from their attorney. Because at the end of the day, the attorney's, trying to protect the seller, whatever reason they don't understand it, and they weren't given the right information, and that killed the deal. Okay, so working with us, when we closed this Morby Method, I mean, there were so many things happening. Title company didn't understand all the nuances of how to do all the language, so it doesn't trigger anything with our DSCR loan. The seller had, there's a lot of things with the seller. So, the good TC would get all counterparties on board so they all have an understanding. Super, super important. Of course, me being the lender, I helped smooth everything over. So make sure everything was just done properly. I even provide the transactional loan as well. So we're a one-stop shop for DSCR and transactional lending. And so what had happened was to make a very, very simplified version of what happened. So this is what happens on a Morby Method. And it's, I forgot one thing too, mentioned on DSCR loans. I didn't mention this, which is very important. So you need to have a borrower that also, it's not that they don't have money and they can't close. That's the worst borrower. Also, they have to have good credit score. Typically, I would say 700 plus, and they need to be liquid, because there's and us as a DSCR lender, we do run soft credit pulls to mitigate from any surprises. So the good thing is, from the one that we did in Cleveland, Ohio, we had an investment banker. He's sitting on a decent amount of money in the bank, which really helped navigate this, because the problem is the people that want to buy properties with no money and they don't want to put any money out of pocket is not a good borrower, because this is the problem. The seller didn't want just any buyer. They wanted a buyer that actually had liquidity. Why is that? Because God forbid there's, capital expenditures, you have problem tenants. And if the borrower can't cover the debt service, that's going to put the seller in jeopardy. And in reality, the seller, the seller or the original owner, because obviously it's transfer title, but the one offering seller financing does not want to have to foreclose on the, obviously they don't want to have to foreclose on the buyer and then have to figure out how they take over the property to, now they don't want to take back properties, right? So really it's for a strong borrower that has liquidity. Another thing is, you're going to need to have 3 months typically 3 months seasoning of where you're sourcing that down payment money. Plus, it's like 3 to 4 months of monthly payments. Every lender's a little different, but you need to have that liquid as well. If you don't have that liquid, there are ways to navigate that, and we'll talk about that another time. But in reality, if you don't have that liquid or have any liquidity for capex or payments, you should not be doing this, because it's just going to put yourself in jeopardy. It's going to put the original owner in jeopardy. He's offering you seller financing. It's just, that's a recipe for disaster. You really need to have liquidity. It's for people that have money and also want to use OPM. If you don't have liquidity, I would recommend finding a partner that does, to really protect everybody, protect yourself, and protect the owner, because we don't want to give this a bad reputation. It's an amazing strategy, but obviously you have to be you have to you have to do it the right way. That's all I could really put it. So this is how it happened. Very simple. And I'll try to make it so we can always ask questions later. Is let's say actually I probably have an example right here. Let me go back. I know I have a sample here. I'm probably overstepping this. So minimize cash out of pocket, great for cash flow rentals. So DSCR, so basically, let me step back to that, and I'll tell you a little bit why you're using this method. You're going to minimize cash out of pocket, great for cash flow and rentals. One thing I want to say is that is you have to think about your blended rate, because the DSCR loan is going to have a rate, and the seller, I mean, if you can negotiate a longer term and zero interest, that's amazing. But if the seller's like, yeah, the one we did in Cleveland, Ohio, it was a 5-year term for the seller financing, and I believe the rate was 8%. So it was not a cash flow play for the buyer. It was an appreciation play, which means there has to be some type of capital event. What that means is it's either a sell or a refinance, and you want to have a longer term. The reason being is because there's market risk, and let's say it doesn't appreciate, because when you're banking on appreciating, you're speculating, and you're basically is it gambling? In my opinion, you're betting on the market to be steady, appreciate at a certain rate, and hopefully there's no recessions, there's so many things that can happen. Hopefully it doesn't, but the longer the term, like if it's a 3-year term, you're not giving yourself enough room for error, because basically the longer term out, I mean, maybe the market's going up and then it dips a little bit and then it goes up, but hopefully longer term, it's a uphill trajectory versus just, so that's something I would, because the thing about it, if you look at like you can look up like a chart, let's say, you can see prices, it goes up and down, right? Well, let's say you look at a 1 year, it may just go up, and then second year it's down, right? But let's say you stretch it out, hopefully it's up more, right, than where it was from year one. Maybe year 5, it's up more from year 1. So that's the time you look at a refinance or sell. But let's say you're stuck in year 3, and year 3 is lower than year 1, or just about that, then that's a problem, right? So if the longer the term, the more room for hopefully you can make that decision when you want to sell or refinance. You give it more time, and that's what you need for. So high level view, trying to really make it very simple, not get too technical. This helps get the seller what they want, because what's happening here, the seller's getting their down payment they want. Remember, going back to my example, right? Seller one was giving 15% seller carry, meaning the buyer had to come out 85% down on the purchase. And I wish I knew this years ago because I was working on a seller finance deal on a deal in Newark, and it would have been perfect for this. And I didn't know about this Morby Method back then. And they wanted something similar, and I didn't know. And that was the problem with the down payment. It was a 8-unit, or I forget. It was a nice property in Ironbound. Seller wanted a large down payment, and I didn't know about it. And it was the large down payment that was killing the deal but if we knew about the Morby, we could have reversed it where it was sellers getting what they're getting their large down payment, and the buyer is not having to come up with all that equity, which is good. And you can scale your portfolio. So now, I kind of mentioned this before, lenders restrictions. Most lenders do not allow second liens. We have a way around that. I'm not going to say it here on a YouTube live, not doing it, but I have a way to structure things properly, and then we can kind of navigate that together. We do it all the time, these structures, but you have to do it the proper way, okay, regarding the second behind DSCR. Going back to the seller confusion, so what I was mentioning before about the phone call I received, the not having the right TC, and obviously the lender, and you have an attorney representing the seller that's just a deal killer. The inexperienced TC just basically didn't know how to handle the objections from the attorney, and that killed the deal. So you really want to have a experienced TC, experienced lender that can help educate all counterparties, because you have a title company that doesn't understand it. If you don't have a title company that doesn't understand it, you could always move a title company. That's not a big deal, but you really need to make sure the seller is on board with this. And you have to educate them of all the reasons why they're going to be comfortable. And of course, the benefits to them. I mean, there's so many benefits. You're getting a large down payment. There's tax benefits and whatnot. And of course, how do you negotiate with them? That's another topic that we could discuss. Over leveraging. So I was touching on that as well as whereas when you're buying these properties with little to no money out of pocket, it's not because you don't have any money. You need to have reserves somehow, because there will be problems. You're going to have capital expenses. You're going to have to fix things on the property. It's the headache business. Welcome to real estate, and you need to have reserves to cover when things go wrong, and they will go wrong. Nothing is ever perfect. You're going to be dealing with problem tenants, and guess what? That lender, the DSCR lender, doesn't care that you have a problem tenant. You can't make a payment. They don't care. All they care about is you making payments. And once you go 90 days out and you stop, it goes 30, 60, 90. 30 days, you get like a notice, 60. And then once you go 90 is the trigger that they could start initiating the foreclosure process. That is bad. You're going to be getting hit with, basically, depending upon the judicial or non-judicial state. That's something that, that depending how which state is they're going to file like a list pendants or foreclosure, a suit, if it's judicial. But basically, you really need to have liquid money, and I'm sure the seller, if they're savvy, going to want to make sure that the seller that we were dealing with in Cleveland, Ohio, was not looking for. They were looking for the right buyer, because they don't want someone over leveraging where they have a problem tenant, they can't cover the payments, and now they got to take back the property. They don't want that, and you don't want that neither as a borrower, because at the end of the day, that could, if you are now getting hit with foreclosures and a lawsuit, that's going to put you out. And you're not going to be able to get a loan for 5 years or longer. And that's not good. And that could really hurt your reputation and your business. And you really want to avoid that. So you want to underwrite conservatively, because remember, it really depends upon, obviously this is a whole nother avenue. I could talk about DSCR loans, but you want to be really at a 1.2 DSCR. What a 1.2 means is that the 20% profit over a break-even rent. So that's your cash flow, 20%. And I mean, obviously you could go lower, but when you're going lower than that 20%, you're getting tight. So that could be challenging. And then also, if you have seller financing charging you interest, now what is your blended rate? And then you may be negative cash flow every month. And now you're just banking on appreciation, which is speculating. And do you want to really be negative? Not me. I don't want to be negative. I want to at least have cash flow to cover all my expenses. And then hopefully you'll have that appreciation where you can refinance or sell later on. Pace talks about always negotiating 0%. If you could get that, that's even better. That's amazing. And that's like the holy grail of this. If you could negotiate the longer term at 0% from the seller, if you could do that, that's fantastic. So, like I said, legal pushback over here. I mean, this is what I was mentioning before. Title companies will resist because they don't understand it. You got to. So what we did was I had amazing TC. We used this lady Jace. She was amazing, and there was a lot of communication from the seller, from the title company. The title company wasn't really understanding how we had to handle the documents and the wording to not trigger anything with us as the DSCR lender. And then there's the seller figuring things out. We ran into problems with payoffs because, I mean, there's so many things that happen because obviously you have appraisals. We had credit. We needed the credit score. So the good thing is we run like multiple, we run soft credit pulls. So let's say your credit is, it's close, right? Well, as long as it's not messy, a lot of times it's, which is not bad. It's actually, it's a pretty common thing if you just have a high utilization rate on your credit cards. Then basically by paying off some credit card debt, getting below that 30% should jump your credit score. And then you get to where we need to be. And the good thing is while we're in the process of getting this underwritten, getting to that agreed to fund, we could run multiple soft credit pulls till we could get to where we need to be. But going back to, you want to have investor-friendly title company attorney that's not a deal killer. Really, I mean, but obviously you're not going to choose to sell as attorney, so you're going to need to have an expert on your side that can educate that attorney and the seller. You're really going to need to do that because an inexperienced TC could blow up your whole deal. And working with us, we have all those resources. Overpaying, don't get greedy. That's another thing that I see, but that's another discussion. I mean, look, at the end of the day, right? So give me a second. My apologies. My phone should be off. So what happens with these DSCR loans? I mean, there's credit. There's no tax returns required. And obviously you're looking the cash flow of the property, but how to determine that is based upon, there's we have to order an appraisal, which is an as-is with a rent schedule. So the good thing about working with us is you could pre-screen a loan with us, and I can show you that right here. And because I have a lot of people that call me up, hey, I want to know about the Morby Method. And I'm going to have to put out videos because it's getting challenging to cater to everybody. And maybe I'll do like a weekly meeting. I have to figure that out because I'm only one person. But I would say the best thing you could do is really pre-screen it by us, because the first thing you need to do is if you have a seller that is open to terms, great. Okay, now you have the first thing. That's amazing. Now we need to underwrite you. We need to know two other things: the characteristics of the borrower and the economics of the loan. Two things. And this takes about 5 minutes. All you have to do, let's say you're a borrower, right? Just come here, choose your borrower, choose your target closing date, choose the loan product, DSCR rental, desire leverage. The max we give is 80% of the purchase That's what we do. We can do max 80% on a refinance rate in term, 75% on a cash out. Okay. Put your purchase. So the cool thing is, if it's not under contract, we can give you approval funds. This is by pre-ski with us. So basically, going back to this, so you're not overpaying, because at the end of the day, we could tell you, hey, your purchase price. We could look at the numbers based upon what your cash flow, like what the DSCR is, and obviously we could run a soft credit pull so you get pre-approved with us. But we could look at the numbers and kind of work it backwards. Say, you know what, you need your rental income to be here to justify this DSCR to get to where we need to be, or you need to have a better price for it to make sense. Us as a DSCR lender, we always, and this is any lender out there, always lends on the lower of the two, the purchase price and as is value. So if your purchase price is less than your as is value, the loan's going to be on the purchase price. Always remember that. Very important. And then you need to make sure, make sure you know your numbers, because at the end of the day, a lender's okay, fine. They'll take your numbers for what it is. It looks great. And you're very optimistic on your rental income. And they're going to be like, oh, yeah, I got an amazing appraiser. Well, guess what? Lenders are scrutinizing appraisers now. They're really cracking down on it. Lenders want that. The lender wants this to be an arm's length transaction. They do not want borrowers choosing their own appraisers. And another thing that you have to remember is that there's two appraisals on these DSCR loans. You have a full inspection with as is, rent schedule, and then you have a desktop review. So I've had it happen in the past where we had a really good appraisal, allegedly, on from the borrower. Obviously, everything looked, but then when you look at you start, we had the desktop review. It was one of our third-party due diligence companies that reviews their appraisals looked at it and said, nope, the appraiser could not find any comps that were close by, so they had to start going further out to find comps, and it basically was flagged, and it blew up the whole deal basically. So that's why they have a desktop review, to mitigate from that happening. And also the reason why is because these loans are being securitized, they're being rated, sold off to investors, and they're really pricing more risk into these loans. It's becoming, there's a lot of data out there as well, and there's a lot of data science to this, and they're really they're using AI, maybe independent inspectors going out, maybe one thing, because obviously you want to see the inside of the property, certain things, but then again, there's different ways to figure out the numbers. A lender may say, hey, I see that appraisal, but I don't agree with that value. I don't see it. They're gonna cut that number to what they feel comfortable with. So just you have to be careful of that. So going back to working with us, we could try to run our own internal evaluations, but I may say, hey, I'm not an expert. I don't know that market, and that's another thing I totally just dawned on me that I should bring up. Rural properties, another deal killer. We could finance a rural property, but it's just the underwriting is completely. It's reduced leverage. Put it that way. It gets even trickier. That could kill your deal as well. So a cool tool we have on our website, by the way, make sure the property is not rural. Just please do that. What you could do here is go to levinecapital.com. You go to resources, go to rural search. Mars, please change it to rural property search. Okay, rural property search. Just make sure you put the property there. Thank you. And if you're listening to me now, rural property search. Okay. Then what you're going to do is we just add this to here. This is the Consumer Financial Protection Bureau website. You go here, you plug in your address, boom, click. What did I just do? Boom, not rural. That is it. This will give you a good idea, okay? Because that's the first thing we do. Because if it is rural, numbers change, everything's different, and it becomes it's just more challenging. So that's the first thing you want to do. on a Morby method as well on the property. Check and see if it's rural. And another thing you may want to do, what I would highly recommend, is have local, like, have resources to kind of give you a good idea what the as is value is and what the market rate rents are, because that, I mean, we could find out once we get an appraisal, but with me, I'd rather like say, hey, you know what? Because whatever. So when you submit a loan submission to us, you get an automatic email to validate all information, and then we're going to say, hey, can you send us 3 comps? Go find a local realtor to help you out. They'll have access to the MLS, and they can help you find that. At the end of the day, we want to make sure this is feasible. Like, we don't want to just waste time and resources, your money on just, oh yeah, it's just on an appraisal, get this thing, kicked off, and let's go to find out, yeah, deal's dead because the numbers just don't work. Okay, so that's everything I was saying. Expertise, lender knowledge. We understand all this. We can help mitigate a lot of these setbacks that can happen. The lender restriction, we got you covered on that. Sellers, you have resources from my end, myself, and an excellent TCs that we work with that can help navigate these objections from sellers and their counterparties or title companies. So we make sure everybody's educated. Over leveraging, remember, I like to be upfront and make sure you have liquidity. And I'm right now working on videos to basically, because right now I'm educating people, but it's hard to do it all at once when you have a lot of submissions for the same thing, and it's just a lot of conversation. So I need to have this content so we could basically speed up the process to avoid any miscommunication. Legal pushback, I mentioned that before. You may have attorneys, title companies, whatnot, just they don't get it, overpaying. It's not worth overpaying, because at the end of the day, it's always the lower of the two, the purchase price or as is value. Working with us, we can look at the numbers and be like, yeah, you know what? This is your leverage is not at 80%. It's going to be at 65% because you're like at I'm making up numbers. Your DSCR is like not a 1.2. It's way lower than that, a 1.1. I'm making up numbers, so don't hold me to that right now. What the leverage would be, and that could maybe it still could work if the seller's giving you a lot, right? So here's a step-by-step, and I'll get more into it later on. I'm kind of getting a little, I love this. This is something I could talk in my sleep. It's just a really cool subject. I talk about it a lot, and this is madness right here. So amazing. Check it out. So step-by-step walkthrough. Find a motivated seller, right? You need to identify sellers who need to sell, but also want a good price for their property. There's also another thing. They want a large down payment and maybe tax benefits as well. So there's different things as well that you're going to look for. Negotiate terms creatively. Propose a hybrid structure that meets both your needs and seller requirements. You want to have a DSCR lender. So the one thing I would say is, give me a second, I have my allergies. You want to have make sure you have all your ducks in a row. Like, have your DSCR lender ready. So come to us. Let's say we pre-qualify you. We run a soft credit pull. We know you're good. We have the transaction coordinator. Everything's ready to go. So then when you have that deal, now we can go, and it's easy peasy. Like, it's not like, oh, I have the seller. Great. Now I got to find a lender. You're scrambling around and the TC. It's just like, it delays things. You can run through a problem. We have an inexperienced TC. It blows up the deal, or inexperienced lender. It blows up the deal. So make sure I have all your ducks in a row. Have a seller carry the rest. So obviously, you want to structure terms favorable to, it's got to be, the seller's going to try to possibly do the shorter term and a higher interest rate, you really want to stretch out the interest rate, stretch out the term as long as possible, and don't go less than 5 years. Just don't do it. It's not a good idea, and the market risk is like I mentioned with the, not everything goes straight up, right? There's up and down, and maybe there could be a big pullback. Who knows? There could be a COVID hopefully it never happens again. But I was there. We were lending and everything. All the securitizations, everything just stopped. You had DSCR, you had loan commitments, and that was it. Like that, normal lending just stopped. And then it was back to the old days, like the real hard money, very expensive money because there was no institutional capital. And obviously you want to have the right team as well. Super important. Okay. And so here's a very simple version. This is Manus, and I did not proof this whole thing. Property value 650, DSCR loan 422, seller financing, cash to close. So I don't really want to use this as an example because this was Manus, and so let me see. Seller benefit received $422,000 cash at closing. The investor win acquired. Yeah, so that's basically, I'm not fact checking all these numbers right now because this is all Manus. It probably is right, but basically the key outcome, seller benefit, because they received that large down payment they wanted. The investor won because they're able to buy a $650,000 property with $13,000 out of pocket. They're cash flowing $1,335 a month from day one. The annual return invested capital is 123%. Seller financing, 10-year term, 5% interest. Look, this is amazing. Manus was able to give me an example of a 10-year term. I might have gotten this example from Pace GPT. It was interesting because I use a lot of AI. I use Pace GPT, right, which is exclusively for Owners Club members. It's basically Pace's brain, all data that could go to. It's like a clone of Pace. It's amazing. And then I put it in ChatGPT to add a little stuff, and then I threw it to Manus. So I use like a lot, and Manus put together this whole presentation basically out of Pace, ChatGPT Pro to Manus. So yeah, that's cash flow is 2% of the value. Interesting enough, this is a Cleveland deal, which we closed many Morbies in Cleveland, Ohio. So common questions about DSCR loans. Look, so this was something that I would have edited. Look, at the end of the day, there's some challenges to having a low credit score. What I've seen lately in lending is when there's a lot of volatility in the market, when you have our president's talking about tariffs, bonds are rising, stocks are dropping, volatility, the DSCR loan rate is very, very volatile. It moves daily. I'll get like rate sheets every day, multiple times a day. And I've had it happen to me recently where guidelines change from one of our capital providers or loan buyers that say, look, we had a 660 minimum credit score, now it's a 680. And that's a problem. We have resources for the 640. I don't recommend it though. The terms suck. And what if you were expecting it to close and then market conditions change, and now you're like, sorry, now it's a 680, can't do 640. That's a problem. So, but the DSCR loan is sensitive to credit and it is sensitive to cash flow, and nobody wants to get stuck with a DSCR loan on their books. So that's a whole other discussion, obviously the capital market side, but this is something that I would be just cautious about you want to be in the sevens, high sevens, the better. And just that's just very important because you may, like I said, you may have a term sheet. Yeah, it works at a 660. Usually, most lenders at 660. We do have a resource for the lowest to 640. I always deter people from that because, like I said, it's just not the best terms. You have a high interest rate, low leverage, and I mean, if they're desperate, I'll help them out, but I always try to give them their best options. Then you have to be able to figure out how do you explain this to the seller, and obviously focus on the benefits. So you're gonna want to, what credit score do I need right here? The good thing with us, what I want to mention is, where is it? I had it here. Let me find it again. So working with us, we have a soft credit pre-approval process right here. So the cool thing is we don't charge for our soft credit pulls, which is really cool. Don't pay for it or don't pay for approval funds. I mean, just come to us. Obviously, look, I've had it happen where I was just giving them away and then people abuse it. They abuse it, and then I have to now do some vetting. We run soft credit pulls. Once you're in our system, okay, once we run your credit through a soft credit pull, and we know your track record, it is instant. Every time you ask, boom, 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 you can get that in our system. It's flagged, you're approved, and you get that. Okay. And that's it. I mean, so then you're gonna know what your credit score is, and that's gonna avoid any surprises. Just keep in mind your credit's gonna change when you start charging things on your credit card and buying things, or you buy a house or a car, it's gonna change, and then you come back to us, we're running again. And that's another strategy I discussed last week. I think it was last week about the business credit. Just I'm talking like when I think it was last week we did the business credit. But that is something you want to be cognizant of. You want to just, things could change. Okay. You want to be able to explain, the benefits of why the seller, should entertain this idea. It's very common practice in commercial real estate. We're saying commercial or, these are business purpose loans. They're not consumer loans. All these loans are non-occupant loans. Okay. I just mentioned this before. It's a lot of repetitive stuff. The DSCR lender is going to look at your credit and cash flow of the property. Obviously, location. I mentioned location too, where I mentioned that rural property search. So that is very important. Obviously, appraisals will determine condition, all that. Property condition, investor experience. There's lenders out there that they don't want to lend to someone that's a beginner out of state. That's another thing. So just come to us, pre-screen it with us, and we'll avoid any surprises. I don't know what I just did. Okay. So, okay. This is, so we'll help you out with this. Just rural property search. Remember that. And now, so this is really we're really almost at the end. I want to highlight a few other things here. So what I'm working on is an initiative to work with a lot of transactional lenders and a lot of transactional coordinators. And what I'm realizing is that they're missing, there's a lot of things I'm trying to bridge the gap. We offer a white label program, whereas we could talk about later on. We could, if you're a transactional lender, we could brand it to you as a DSCR lender. We want to be your preferred DSCR lender to help you make sure this is smoothly. You get paid as a lender fee, a broker fee, whatever you want. We could structure it. We could work the numbers so everybody's happy. Transaction coordinators, we have an initiative to help you earn more income working as a lender with no mortgage license required, and offer more of a service than just be doing paperwork or whatever, or coordinating with different counterparties. You could also earn lender fees. And so what I want to mention is, let's say going back here, get your quick quote, right? So here, you go here, um, quick quote right here. And what happens is you always book a call. You can always call our number, try to get hold of me, proof of funds right here. Um, you put down, let's say you're not signed up in our system. You're a transaction ledger, transaction coordinator, wholesaler, connector, broker, gap funder, whatnot, right? When you put either of these in here, or let's say you're existing. If you're existing in our system, it's easier, right? You're going to be emailed, not the borrower. You'll be the direct intermediary between us and the borrower if you are a broker, connector, wholesaler, transaction coordinator, transaction lender, gap funder. Okay? You're going to choose, could be DSCR. We even do it for fix and flip as well. Then you're going to choose, it's going to ask you if it's a Morby method. I did show that before. I'll show it again. You choose the purchase price. When did you buy the property? Oh, that's the wrong one. Sorry, DSCR rental. There we go. Is this a Morby? Yes or no? Right here. So if you are looking to partner with us, you can just sign up for a white label. This is something new. We are rolling out. We have a new portal. We're rolling out. It's really exciting. We have become a connector is another one. Transactional lender. This is you got lender fees, no licensing required. We want to be your go-to DSCR lender as a transactional lender. We will help you earn more income for your service. Same thing for TC. You're going to earn more income with your service. And that is it. I am not done yet. We will have more. Oh, look at this. We have another one. Forgot to mention Gator lending. Morby Method financing. Boom. Right? Here you go. Fund your seller finance deals with minimal or no money out of pocket. We put institutional financing with seller financing for maximum leverage. Qualifies fix and flip loans, DSCR loans, bridge loans, expert support. And here's a quote from Base. Levine Capital is the go-to DSCR lender for the Morby Method because they understand the intricate balance of creative financing. Their expertise in structuring DSCR loans ensures seamless integration with seller carrybacks, allowing investors to secure deals that require large down payments while maintaining cash flow and flexibility. This is PaceGPT. Quote from PaceGPT. Pace is Morby's clone, which is really, really cool. And this actually shows you how to submit it. Okay. We're going to have way more tutorials on how to do things. It is super easy. We also have an amazing chat bot. Check this out. What is a Morby method? Try this out. I am putting a lot of resources into this chat bot to help answer questions. And watch this. Boom. Right there. It's going to help. And then I'll put even more stuff in there, how to do more stuff as we go. So anyway, anybody have questions? It's Friday. And if you don't, just feel free to, message back or whatever. You can message on YouTube. You can email. Try call me. Look, my phone is, if I don't answer you right away, just ping me again. I don't just nudge me till I get back to you or find someone on my team because I have a lot of emails, a lot of messages. It's hard for me to keep up these days. So, and we have more help, but book a meeting or nudge me. Don't. I actually appreciate that because I'd rather you nudge than just go somewhere else. It's not that I intentionally not answering. It's just I get flooded with a lot of messages and it's hard to keep up. So anyway, thank you so much for listening to me, and we will have another topic, another discussion on Morby and bring in some experts to help guide us through the process. So this is a very high level view. I hope this helps everybody out. Thank you so much, everybody, and I hope you have a happy Friday. God bless.